Hello, everybody. So it's the end of the day in Europe, and it's almost the end of the day in the US. And this is a Sunday, which means that it's often time when deals happen and deals are brokered by governments. And we just learned that UBS is buying Credit Suisse. And they're doing this because, of course, Credit Suisse was in major trouble from a lot of outflows and a great reduction in the value of their assets on the balance sheet due to the rise in interest rates across the world, especially in the US and as well in Europe. On Wednesday, there were more rate hikes. This makes the value of those bonds go down, and so these companies become upside down on their balance sheet. I just want to go over the news, right? UBS agrees to buy Credit Suisse for a tad more than $2 billion. And at the last trading hour, this company was almost a $7 billion company. So you get even more of a haircut compared to what it was worth. But what's important to note is that this is a company that's, I think, a little more than 150 years old. And all I want to say is that I feel great mostly owning tech and growth stocks with zero debt or close to zero debt, or at least zero net debt. And I think it's important to know what you own when you invest, because you see a lot of financial gurus telling you, you gotta buy a total world stock index fund. Well, if you own like a world stock index fund and you decide to diversify across the world, well, you're owning companies like Credit Suisse, like UBS, like Deutsche Bank. And I haven't looked at the balance sheet of Deutsche Bank or UBS, but I'm pretty sure it's just as bad as Credit Suisse. If you were in the S&P 500, right, you bought into companies like First Republic, right, which is in deep trouble right now, and Silicon Valley Bank, who had a bank run. You're buying these stocks that are so leveraged up that if they have a mismatch between their assets and their liabilities that becomes too big, too much against their favor, if they have that mismatch, the company goes bankrupt, essentially. This is what has happened because of that swift rise in interest rates. This would not have happened if interest rates had been risen for, say, 25 basis points every year or every 9 months. This would not have happened. This happened because these companies don't have enough time to let their debts mature. And that's why you create this kind of madness going on. And, I just want to say, in the case of Credit Suisse, they had 41% fewer deposits across the last year. So the number of their deposit fell by $172 billion. That's what happened to Credit Suisse. And so now we know that Credit Suisse is getting bought because they were essentially bankrupt. And it's getting bought by UBS for 55 cents a share. So it's a haircut of like 4 times less compared to what it was trading at. 55 cents a share. And they're buying, UBS is buying Credit Suisse with the help of the Swiss bank for $100 billion new line of credit that's going to be given to UBS. And this is what I couldn't find, but I assume that the $50 billion line of credit that was given to Credit Suisse is remaining too. I'm not sure about that, but that's what I'm assuming. So assuming that means that it's another $150 billion in base money that the central bank is going to have to print, right, in base money to allow for this bailout of the second biggest bank in Switzerland by the first biggest bank in Switzerland. And this is one thing I want to say about the SEC. There's things like everything. There's things I love and don't like about the SEC. One thing that I love though is the transparency and how transparent they are. And you can clearly see what happened at Credit Suisse when you look at the reports, right? So you can see they had $828 billion in assets, and I believe Credit Suisse had been doing everything it could to try to get out of this mess that it got in 2008, and slowly trying to reduce the balance sheet, at least trying to do a good job. And of course, that $128 billion in asset turned into $574 billion. So you have almost a $300 billion delta between 2022 and 2021. You can see it's very stark compared to any of the other years. And what happened? Well, the biggest, fastest rate hike in the history of rate hikes is what happened. The interest rates have not been risen this fast ever. It was actually more than a 20-fold increase. And that's what happens to bonds. When interest rates rise, bonds lose their value. And banks own a ton of bonds because whenever they get deposits from their clients, they have to invest these deposits in long-dated bonds. But when their clients exit, you get into an issue where the bank runs out of liquidity and goes into quote-unquote paper bankruptcy, which is why not only the Bank of Switzerland had to intervene with another 50 billion, and now we can see that they brokered a deal where the two biggest banks in Switzerland are merging with 150 billion in new money, 150 billion of help. But there's more unfolding, right? Because we know that this type of deals typically happen on the weekend, and they're announced at the end of the day wherever you're at, so that Asia, when the market opens in Asia, you have a positive reaction. That's often what they try to do. And one thing that I'll ask is, are we going to hear a deal in the US tonight, right? Is there something going on for the U.S. regional banks by the end of the day? And I actually love Twitter for this. This is Fuzzy Panda. I'm sure Fuzzy Panda is a reliable source. And actually, you can go on this website and look at a lot of the jets from major banks. A lot of those jets are in Omaha. Now, why would they be on Omaha on a Sunday? Well, because that's where Buffett lives, right? Buffett is in Omaha. And I actually was seeing on Twitter that apparently Jamie Dimon's jet could have landed in Omaha this afternoon. So Twitter is very interesting for that. You can see that there's a bunch of private jets in Omaha this weekend. And so what does that mean? Are they trying to get bought out? Are they trying to are they trying to broker a deal with Warren Buffett? Because we know that Warren Buffett loves banks, and we know that he has $128 billion on the balance sheet. And if you remember the Bank of America deal, love the title of that CNBC article, Warren Buffett just made a quick $12 billion on Bank of America, on the Bank of America deal. So he may do something with preferred and try to see if he can take this to his advantage, with a bunch of regional banks in turmoil flying to Buffett. And Buffett has been bailing out banks since 2008. Also did it in the 90s with Salomon Brothers. He's a contender to buy this. And what I will say is I'll finish with this. Know what you own. Yesterday I made a video about why I own Bitcoin as opposed to bonds. I believe bonds are just derivatives of this pie of money stock that is ever growing, right? The 150 billion that I identified from the Bank of Switzerland, the central bank, that's new money being printed. And so I believe Bitcoin is entirely decorrelated from that. It was actually created to deal with that. It's a money that you know exactly how many there are. But anyways, this is not a Bitcoin video. I made a full video about it yesterday. I think a better question is, one needs to be very careful about the balance sheet that these companies have, because the more debt you have on your balance sheet, the more it makes you fragile, and you can have a very quick demise when you have things like rising interest rates. Utility stocks, legacy auto, insurance companies. Be very, very careful. Look at what you own and look at how much debt they have and how that debt is structured, right? Companies have a strong incentive to borrow money and increase debt because it increases their return on equity, right? Return on asset is often too low, and so in order to justify certain investments, they have to go in debt to create a greater return of equity. That's why they leverage up, right? It's leveraging up. But you got to be careful, because whenever you have a shift in the market, a stark shift in the market, like for example, the banks, they've been doing this business for the longest time, but what they didn't think is that there would be a 180 turn in interest rates, right? The Fed did a 180, and you had the starkest, most insane shift in interest rates that we've ever had in the history of interest rates. Banks didn't plan for that. And you got to be very careful, in my view, with the investments that you own, because, for example, as you know on the channel, I like Tesla. I wonder if there's other YouTubers out there that like Tesla. Anyways, I like Tesla, as you know, and one of the reasons why I like Tesla is because I believe Tesla is anti-fragile. If you look at Tesla has $5 billion in debt, and Ford has 24 times more debt than Tesla. It has $140 billion in debt. And when you have a stark shift in the market, like let's assume that right now we're at the beginning of the EV adoption curve. That adoption curve is for Tesla is about 4%. EVs in the US is about 7%. Let's assume in 2025, 2026, EV sees a stark increase in adoption. Very, very stark increase in adoption, a total paradigm shift in what people want to buy. And let's assume you have so much debt. Well, if you have so much debt, and all of a sudden you have a 180 shift in the market where you move to a market where nobody wants an electric car to a market where everybody is an electric car, and you engage in revenue financing, right? In the case of a lot of legacy auto companies, they engage in revenue financing where they actually finance their own vehicles. If you have that issue, then you better hope that people buy their car at the end of a lease. And you better hope that people don't choose to just get their cars repoed when they did in 08. Because the value of that collateral, the value of that asset that you own, that title on that car, is going to go down much quicker than the amount of debt that is owed on that car, right? So you need to be very careful about a re-rating of that collateral and a re-rating of that debt, which we can easily see when a company has almost 3 times as much debt as market cap. You can easily see how any stark movement in the market can entirely wipe out the shareholders, entirely wipe out the company. That is what happened to these banks. These banks were wiped out, right? You had, in the case of Credit Suisse, you had a company with a $7 billion market cap. Let me show you those numbers again. A company with a $7 billion market cap and $574 billion in assets, down from $828 billion. So of course, this is very, very dangerous to own when you have companies that have so much debt. So be very careful what you own, I guess is my view. Is I am careful, and anti-fragility is so important. Owning companies without debt, owning money without counterparties, and that's also why I don't have bonds, because bonds, you have a major counterparty risk, which you don't have when you own, say, Bitcoin or when you own say companies without debt. So anyways, this was not investment advice. This is just entertainment. Thanks for liking. Thanks for subscribing. Have a wonderful day.